Hello and welcome to our webinar today on Is the Endowment Model Still Alive for OCIO Management? This is Frank Szymanek with Plan Pilot in Chicago. I'm the OCIO due diligence specialist here at the firm and will act as our host for today. And we're glad to have those of you who have dialed in live and those that will listen to the recording. We welcome you as well. So we chose this topic today looking at the endowment model, and what we mean by the endowment model are portfolios such as endowments, foundations, reserve assets, and so forth that are very broadly diversified, heavy use of alternatives, private assets, illiquid assets, real assets, and so forth. And at a very minimum, this introduces much greater complexity and fees. Over the last couple of years or so, we've seen some challenges, though, in performance from these different measures. So we've got the Nakubo study, one of the leading industry studies, has shown for a couple of years in a row that these larger multi-asset pools have not performed as well as simple public markets. So, and this has been a trend. Of course, we've been here at the later stages of a 10-year bull market where public market equities in particular have done extremely well. So it's been a challenging benchmark to meet. But we're also in an environment of increasing market uncertainty, which leads to greater volatility and risk. The result of this is that asset owners are reevaluating their strategic view of their portfolios and weighing the trade-offs of chasing the returns that these other asset classes may offer versus the risk management and the ongoing assessment of the fees. So with that background, I'd like to get started, jump into the presentation. And we're going to cover these questions here today, which hopefully you can all see on your screen. So we're going to dig into what role should alternatives and real assets continue to play for endowment and foundation portfolios. There's often illiquidity attached to them, so is there still a premium? Do we still get paid for being in these asset classes? There's also a lot of cash flowing into them. And so the question is, how should investors evaluate the opportunities that are out there and get access to the managers that are most likely to perform well? And then what are some of the risks that we should be aware of as we're going through this? So these will be the main questions we focus on today. As I mentioned, I am Frank Szymanek, the OCIO specialist here with Plan Pilot. We do due diligence searches both to hire managers and to provide oversight of existing managers. I also have prior history of being an OCIO provider with a firm prior to joining Plan Pilot. And I'm pleased today to introduce, we've got two distinguished colleagues from Russell Investments who will be leading a lot of the discussion here around the content and answering these questions. So I'd like to turn it over to Lisa Schneider and Julia Cormier to make introductions.
Great. Thank you, Frank. And thank you, everyone, for joining us this morning. My name is Lisa Schneider, and I am the head of nonprofits and healthcare here at Russell Investments. I've been with the firm for just a bit over 30 years. And just by way of background, Russell Investments is a global financial services firm, and OCIO has become the core of our business. We have been providing OCIO services to institutional investors since 1980, and today in the U.S. we manage a little over $70 billion on behalf of institutional investors, including endowments, foundations, plan sponsors, and hospitals. And I'll let Julia introduce herself.
Good morning, everyone. My name is Julia Cormier. I am a director and client portfolio manager in our alternative investments team. I am also based in Chicago and have been serving institutional clients for 30 years, including 15 years at Russell Investments. And I work closely with Lisa and her team in developing portfolios that meet particular client outcomes in the alternative investment space.
Great. So thanks, Lisa and Julia. We're delighted to have you join us and look forward to the content you're going to share. I will just say to the audience, everyone who's listening live is in muted mode. There is a chat function in your toolbar, I think on the right-hand side of your screen. If you would like to ask a question, we'll try to incorporate some of those as we go through. So I'll be monitoring those as we do that. So welcome that. So I'd like to jump in and turn it over to Lisa here on answering this first question that, given some of the reduced return expectations across asset classes in general, and some of the added risks that you get out of the alternative space, is the return potential still worth the added risks and costs of continuing to look at this endowment model? Lisa?
Yes, sure. So if we look at the efficient frontier that we're showing on the slide on the screen right now, this is key in, when we are planning asset allocation strategy with our clients. You start with what are the mix of asset classes that could be included in the portfolio, and when you combine them together in different proportions, what might your expected return and risk be over the next, say, 10 to 20 years. And what we're showing on this exhibit is two efficient frontiers. The blue line outlines the expected risk and return characteristics for a range of portfolios, including public equities and publicly traded fixed income securities only. The orange line shows you how that efficient frontier changes when you add alternatives, including private equity, private credit, private real estate, and hedge funds. So when you look at this, we would say yes, the endowment model, which by definition of the endowment model, we define that as a portfolio that does include a range of alternative investments. We would say that does still work, as you are seeing the expectation that you would have at the total portfolio level a higher rate of return with possibly less risk. Now, what we counsel our clients to understand is what is the role of specific alternative strategies in their portfolio. And by that I mean different alternative strategies play various roles in terms of either return expectation or risk diversification or minimization, and they aren't all the same. So for example, if you look at private equity or private credit strategies, you are giving up liquidity with the expectation that you would get a higher return over a longer period of time. For example, our 10-year return expectations for private equity are 9.8% versus global publicly traded equity of 7.9%. So you do see that additional return. Now, if you look at strategies like hedge funds, the role that many hedge fund strategies play in a portfolio is one of diversification or risk minimization. So not necessarily something that's designed to provide a higher return than your equity portfolio. So understanding that role and what the right allocation within your portfolios is critical. It may be that not every investor should have as high an allocation of alternatives as maybe a large university endowment. And I think, Frank, you raised a key point in your introduction, and we definitely heard this at the NACUBO conference a few weeks ago. We have to realize the last 5 years, the best asset class that has performed over the last 5 years has been U.S. equities. Even much better than non-U.S. publicly traded equities. So it has been true that over the last 5 years, a diversified portfolio has not outperformed to the degree that it may have in the past. And I'm not sure that we would expect that to be the case going forward.
Great, thanks, Lisa. And just to echo, these forecasts are based on forward-looking assumptions, right? So this is what we can
that is correct.
Yes. Where we're headed. Great.
That's correct. So if you look at this efficient frontier, it's the next 20 years.
Great. And so you mentioned liquidity, and I think that's a good segue over to the second issue we wanted to discuss was there are trade-offs here, right? You're going to access these oftentimes through illiquid vehicles. And so the question is, do you still get paid for that illiquidity? And what are some of the kind of the best ways of thinking about the timing and the cash flows around that? So I'd like to introduce Julia to jump in here and talk about the illiquidity premium.
Sure, thank you. So absolutely right. There is a trade-off when making an allocation to alternative investments, particularly in private markets, and in exchange for having your money tied up for a longer period of time relative to listed markets, you should expect to receive something in exchange for that. And what's shown on the slide now, it's a little bit busy, but you can look in detail after the webcast, but what it's showing you is the various asset types within private markets relative to the US equity market as represented by the S&P 500, and also an investment grade fixed income index. Those are the bottom two lines on the chart, and all of the other private markets allocations are above that line over time. So this is a pretty visually clear indication that private market allocations, or an allocation to private markets, have performed better than listed markets, and you should expect to get a premium for having your money tied up for longer than listed markets.
Great. And Julie, before we move on, I noticed the natural resources and real estate appeared to be kind of flattening here more recently. Is there anything unique to those areas?
Well, I think natural resources can be accessed in a variety of different ways, but we do believe that equity valuations, certainly in natural resources, are high right now, and so we're actually looking for opportunities particularly in natural resources, more in the debt side, partly because of where valuations are in private real assets currently.
Great, thanks. Let's move on then and talk a little bit more about illiquidity and how we should think about it from an investment standpoint.
Sure. So when making an allocation to private markets, as Lisa suggested at the outset, having an appropriate allocation given the plan's long-term objectives and liquidity budget is important. However, we wanted to make sure people understood that sometimes there's a misperception about how long money is, quote, tied up in private markets. So what we wanted to illustrate here is showing you an example of some cash flow periods this is reflecting a 15-year period, which is typically the sort of longest period of time that the legal life of a private markets fund would have, and showing you that at the beginning of the life cycle of a commitment, capital is being paid in or drawn down into the vehicle, but it is also being paid out over time. Typically, it starts to pay out as investments get harvested in about year 5. So if an investor were to make, say, a $10 million commitment to private markets, they wouldn't necessarily need to provide all of that $10 million up front. That's different from a listed market where if they make a $10 million investment, the money is invested immediately, and that's where it's allocated during that period. So in private markets, cash is being drawn down over time, so you have use of it while it's waiting to be drawn down. And then as the fund matures and the underlying investments begin to harvest, cash is returned to investors. So it's not as if your total commitment is locked up for the entire period of time, and I think that's an important consideration when you're doing your asset allocation and liquidity budgeting. In fact, the private markets investors have an objective and a goal to return cash throughout the life of the fund, so that's something to consider when you're making an asset allocation decision.
Great. And Julia, doesn't that usually lead to making multiple commitments to different types of illiquid vehicles to maintain a steadier exposure?
That's a great point, Frank, and we would agree with that wholeheartedly. Because of the timing of the cash flows, the goal of, if you were to make you should make an exposure decision and consider that if you wanted, let's say, a $10 million exposure, we would recommend that the commitment that is made is higher than the desired exposure level. Just because of the timing of the cash flows, you're never going to have 100% of your commitment working for you over a particular fund lifetime. So not only is it important to have a higher commitment level than the desired exposure goal, but also to have a regular investment pacing schedule so that you can maintain the desired exposure level over time, because as the cash flows are occurring and harvests are being made and cash is being returned to investors, you want to make sure that you're able to maintain a consistent level. So we would recommend doing that not only with several managers, having a multi-manager approach, but also over a variety of vintage periods.
Great, thanks, Julia. So let's shift over then from the illiquidity aspect to the access to managers, which was the next question. Much has been made that the best managers are really where you need to be invested. In fact, David Swenson, kind of famously about a year ago, suggested that if you can't access the best managers, he would discourage investment in these different types of asset classes. So can you talk a little bit about what that difference means and why that's important?
Absolutely. And the screenshot that you're seeing currently is on the left-hand side showing the dispersion of returns among and between hedge fund strategies as defined by the HFRI index or database, so to speak, by strategy. And on the right-hand side is the dispersion of returns among the top and median and lower quartile private markets managers. So just taking each in turn for a second, it's pretty clear on the left-hand side that the dispersion of returns across hedge funds within those different strategies is pretty wide. And these manager dispersion and returns will change over time. So we're showing you the 3 years from 2017 to 2019, but the manager lineup and composition of these returns will change over time, as you'd expect. And what that speaks to is, in the hedge fund category, not only selecting the managers that do demonstrate a consistent approach to delivering returns in their strategy, but also making sure that they're following the strategy that they indicate their edge is and where they're actually able to deliver value. So an important thing from our perspective when we're evaluating a manager is not only thoroughly understanding their investment thesis and their commercial edge, but also what their underlying strategy exposures are and what factor exposures they have, so that we can combine those managers into a portfolio, or a variety of managers in a portfolio, to deliver a desired outcome. So it is critically important to have, in our view, exposure to each of these different categories: equity hedge, event-driven, global macro, and relative value, because there is significant benefit in diversification across strategy as well as managers. The other thing is to not necessarily just put the portfolio together and forget about it. And Frank, I think you've raised the point in some of our other discussions about how long we might stay with a manager if they are underperforming. And underperformance is a relative term. We're constantly in touch with our managers, not only evaluating if they're not performing up to expectations, but if they're performing way beyond their expectations, because we think it's important that the factors that are influencing performance are consistent with what their strategy is. So we will not necessarily redeem from a manager if they've had a relatively short period of time of underperformance relative to their objectives, if we understand where that underperformance is coming from. But we certainly will make sure that whatever the cause for that underperformance is either being addressed or is understandable within the market conditions. So we will be tweaking manager exposures within a portfolio, and we won't hesitate to redeem from a manager if they're not delivering on expectations, in the same way. So we're evaluating the portfolio regularly, each of the manager's performance, where the factor exposures and risks are coming from, and making adjustments as necessary over time. Just for a second then, on the private markets side, which is, as most people will understand, it's harder to make manager changes once a private markets portfolio is established, because they tend to have longer legal lives, and it's a less liquid market and difficult to redeem. It's not impossible, but it is quite difficult to redeem from a private markets manager unless you go to a secondary sale. But that doesn't necessarily mean that manager selection and portfolio construction is not, it's obviously equally important, but it doesn't mean that it's a static situation either. We, for example, participate in a lot of the limited partner advisory committees, which is a way to have ongoing influence and advocacy for clients, even in a private markets portfolio. It's a relatively small group of investors that are on those committees. But one of the things that we focus on is making sure that a private markets manager is following their investment strategy as defined and discovered through our due diligence process, that they're charging fees appropriately, and that they're not engaging in style drift, similar to something that we would evaluate on the hedge fund side as well. So it's important to make sure that you're in touch with that manager, either hedge funds or private markets, along the way throughout their investment process to increase the chance that the outcome is as expected.
Great, thanks, Julia. And so as we move over to the next slide, can you just give us a little overview on kind of Russell's due diligence process and how do you go about identifying these and managers and retaining them?
Right, and that's a really great point. A lot of the market seems to focus on whether a manager has a good investment thesis and what their return is going to be, and particularly in the light of your comments at the outset that expectations going forward for listed markets are lower than they have been in the, say, past 10 years. And that's a perfect opportunity to consider making an allocation to hedge funds, which help with volatility reduction and diversification, as Lisa mentioned, as well as to private markets, which have an expectation to deliver higher returns than listed markets, and which is historically data reflects, bears that out. But equally important to the investment considerations are other risks that these managers potentially bring to a portfolio that are unrelated to market exposure. And we define that as due diligence on the operational side of their business. And we spend as much time doing operational due diligence as investment due diligence, and the operational research team has a veto vote when we submit a manager to be considered as part of our portfolio. So if they don't pass operational muster, they will not go into the portfolio. And on this page is describing the high-level elements that we evaluate when we're really digging deeply into the manager's non-market risks. And we spend a lot of time evaluating all of their documentation around their processes and procedures, not only reading that information, but going on site to ensure that what their documents show or say they're doing is actually what they're doing in practice. And just a couple of brief examples. On the hedge fund side, we were evaluating a manager and thought they had a great investment idea, and they represented in their documentation that they were reconciling their trades on a frequent basis, and they were essentially represented that they, according to their documents, that they were reconciling trades every 3 days. But when we were on site in the manager's office, sure enough, there was a trade reconciliation report there, but when we looked at it, we recognized that it hadn't actually been reviewed in several weeks. So just a mismatch in the policy of what their documents said they were doing and what was supposed to be their approach and what was actually happening. Now, some of these things can be adjusted, and maybe it's just an oversight, but those are the types of things that we're looking for that could potentially create risks that we don't want to introduce into the portfolio. A brief example on the private market side is evaluating a manager's valuation policy, which is an important element in how returns are represented. And it was a manager that actually already had other investors in it, and we were not comfortable with what their valuation policy was for the underlying assets. And so we raised that with the manager, and they ultimately agreed to adapt or adjust their valuation policy to an approach that we thought was more comfortable, and we ultimately did in fact invest in that manager. But the good thing about that was that not only was that great for investors that we were potentially bringing to that manager, but it also benefited the investors that were already allocated to that manager. So just a couple of things that we look at and examples of things that we're making sure we're comfortable with, not to mention, a separation of administrator and auditor and all of those obvious types of things that have caused risk for people in the past. So we think operational due diligence is equally as important as investment due diligence.
Yeah, thanks, Jerry. And it's an excellent point. Well, most asset owners probably think about maximizing the return, covering spending policy. It's this behind-the-scene work and this other layer of due diligence that's so important to this OCIO process. So thanks for sharing that. I'm sure you could cover a lot more on that at another time. So I just want to give a reminder to the audience, if you'd like to ask a question, you can use the chat. I've got a couple here for us to review in just a few minutes we have left. And I'll also just a reminder that the information in here was largely sourced through Russell, and it's proprietary and meant for the use of this audience only, so to respect that. So a couple questions before we wrap up, and either Lisa or Julia could comment. Is there some size at which the asset pool is maybe simply too small to get into these types of markets, or perhaps liquid alternatives might be a better approach?
Yes, I think, definitely when we look at you're filling out the documentation, generally you need to be a qualified institutional buyer, which generally means 25 million or more in total assets. I think there are probably mutual funds or other strategies on the hedge fund side that are more liquid that you may access. Julia, are there other ways for smaller clients?
Yes, and I think that's a really good question, because we would always advocate that you have a multi-manager approach to a private markets or a hedge fund portfolio, to pick two examples we're specifically talking about today. And in order to get diversification at a relatively small level, you need typically to use a fund of funds for that approach. And that's perfectly acceptable to do that, particularly if an organization doesn't have the specialist expertise in-house to do the investment and operational and legal documentation reviews. So I know fund of funds sometimes get a bad rap, and there is an additional layer of fees associated with that. But if the net of fee returns are worth the investment and the reduction in volatility, then it's certainly something worth considering. And we'd rather have a client invested in a diversified way than trying to pick a manager or two without the expertise and end up with a worse outcome. So that is a way for smaller investors to get exposure.
Great, thanks. And another question, we haven't talked too much about fees, but maybe you could offer a couple of comments here on how do you obtain the transparency of the fees and manage the what presumably would be higher fees for some of these asset classes? Sure.
Well, you've raised a good word, and that's transparency. And I think that is very critical and something that every investor should expect. We certainly expect that from all managers that we consider for part of our portfolios, and we share that information and are transparent with our investors as well. There's no question that there is a higher degree of fees in both hedge funds and private markets. The question, and those fees can range. Some of the ballpark numbers that are used are between 1% and 2% for the management fee, and there is often a performance fee, both in hedge funds and in private markets. Sometimes in often in private markets, that's after a preferred return is offered to their investors. So the manager doesn't get paid their performance fee until the investor has received a certain minimum return. Likewise, in hedge funds, there can sometimes be a hurdle rate, and there is almost always a high water mark, so they can't earn their performance fee until they've made up any previous losses. So the question is whether or not those additional fees are worth it, and that needs to be evaluated in the context of the results, whether it's the performance results, the increased diversification, and reduction in overall risk of the portfolio. So it needs to be weighed in context of the after fee performance and results. And for many investors, they feel like that is worth it, and the results are borne out in the performance of the overall portfolio.
Great, thank you. So I'm going to stop here at the half-hour mark to be respectful of the time we committed. We started with the question, is the endowment model still alive? And hopefully we've presented good arguments here for yes, it still is, but it does need to be thoughtfully applied and managed. So I want to give thanks again to our partners, Lisa and Julia from Russell Investments, for sharing this great content. On this last screen, you can see the contact information for Lisa at Russell and myself at Plan Pilot. If anyone has some follow-ups, we'd be happy to continue the dialogue offline. So once again, thanks to everyone who either listened live or is listening to the recording. and feel free to contact any of us going forward. Thank you.